Good evening, everyone. Today I will be presenting the presentation regarding the solution for the question 1 of the TACC605 Corporate Accounting case study. Our case focus on the Green Energy Limited and how the company should account for its newly purchased wind turbine under the AASP 116 property, plant and equipment. In this presentation, I will explain the rule for the initial recognition, discuss which costs should be included or excluded, and how those apply to the Green Energy Limited. This slide provides an overview of what we are discussing today. Green Energy Limited has purchased a wind turbine for the $5 million, and as accountant, we must determine what part of this cost should be included as an asset in the financial statement. To make the decision, we follow the AASP 116 rule. The main objective is to ensure only the correct directly attributable costs are capitalized. As a AASB 116 states that an item can be recognized as property, plant, and equipment only when two conditions are satisfied. The first one, the company must expect the asset to provide future economic benefit. In this case, the wind turbine will generate the electricity and the revenue. The second one, the cost of the asset can be measured reliably, and since the turbine was purchased for the known amount, this condition is also met. Costs included in the initial recognition also include all the expenses directly required to bring the turbine to the location and the condition where it can operate as intended. This includes the purchase price, transportation to the wind farm site, installation and assembly costs, and all site preparation such as the foundation or electricity work. Another important point is the expected future cost of the dismantling or the restoring the site. This must be included in the initial cost if the company is responsible for it. The cost which is excluded, the first one is the administrative overhead, early operating losses while the staff are learning the system, and the training cost. Application to the Green Energy Limited. In this case study, the cost $5 million. This amount includes the purchase price, shipping, installation, testing, and all other directly attributable costs. All these costs should be capitalized because they help make the turbine ready for the use. Therefore, the total initial cost of the turbine will be recorded as a part of the property, plant, and equipment. To conclude, the Green Energy Limited should record the wind turbine as its full acquisition cost, including all the necessary and directly related expenses in accordance with the AASB 116. This ensures the financial statements are accurate, consistent, and fully compliant with the accounting standards.
Hello everyone, I'm Yefan Zhang. Today I will be discussing question 2. How Green Energy Limited calculates the annual depreciation expense for wind turbines using the straight-line depreciation method. First, the straight-line depreciation method is the most commonly used depreciation calculation approach, assuming that the asset's value decreases uniformly over its useful life. The primary characteristic of this method is that the annual depreciation expense remains constant with a straightforward calculation formula. Annual depreciation expense equals the asset cost minus its residual value divided by its useful life. The advantages of this straight-line depreciation method include straightforward and intuitive calculations, stable and predictable results, easy of use for corporate budgeting, and full compliance with AASB 116 accounting standards. According to AASB 116, depreciation is the process of systematically allocating the depreciable amount of an asset over its useful life. Now let's apply the method to the actual case of Green Energy Limited. According to the case information, the company's total cost for acquiring wind turbines is 5 million Australian dollars. The expected useful life is 20 years, with an estimated residual value of 500,000 Australian dollars. Let's calculate the annual depreciation expense. First, we need to determine the depreciable amount. 5 million minus 500,000 equals 4.5 million. Next, we divide the depreciable amount of 4.5 million by the useful life of 20 years, so the annual depreciation expense is 225,000 Australian dollars. Finally, let's discuss why the straight-line depreciation method is suitable for wind turbines and how companies should determine the depreciation period. The straight-line depreciation method is highly suitable for wind turbine for several reasons. Firstly, per AASB 116 requirements, companies must review an asset useful life and the residual value at least annually, adjusting them if expectations change. Secondly, the value of wind turbines does indeed decrease uniformly over time. Thirdly, wind turbine technology is relatively stable and does not become obsolete as rapidly as electronic equipment. And finally, turbine usage patterns remain relatively constant throughout their life cycle. Regarding the determination of useful life, based on Australia Taxation Office depreciation rules and industry practice, the effective useful life for wind turbines is typically 20 years. When determining useful life, companies must consider multiple factors, including the expected level of physical wear and tear, the likelihood of technological obsolescence, maintenance levels, and operating environmental conditions.
In the third question, we are going to talk about the advantages and disadvantages of using the revaluation model for the wind turbines. So let's review again the features of a wind turbine. So given its energy sector and just the property of the product itself, it is highly specialized and it contains high value and it has a very long lifespan. So when we choose to value an asset, we usually do either the cost model or the revaluation model. So the feature of the revaluation model is that it measures at the fair value and take out the subsequent depreciation afterwards. So the advantages of using this model includes the more accurate and up-to-date valuation, because every time we do the revaluation, we price the asset again on the current market conditions. So it more accurately reflects the price the market is willing to accept on a certain condition. This leads to a more accurate balance sheet. So other than the kind of outdated previous cost of purchasing this asset, when we do the revaluation at the current market condition, it reflects a more relevant and more accurate balance sheet item. And the third one is it can potentially reduce the depreciation expense given like the high carrying amount. So lastly, it might be useful for the financial ratios because if we have a stronger asset base, so the financial ratio will become better. In this case, we might lead to, as what I mentioned here, the higher borrowing capacity. If we show the better financial ratios, the borrowing entities might provide better liquidity or credit to the company. So for the disadvantages, the revaluation model can have very high uncertainty because it is a very specialized product and the market may doesn't exist for this product at certain times. And also given the frequency of doing the revaluation, it may incur higher admin costs. So you're gonna find experts to assess the accurate market price at a certain market condition. So lastly, it might lead to potential manipulation because this depends on the expertise and the management have the bias to give higher value of the revaluation to strengthen its balance sheet. And there are some minor disadvantages, including like the technology issue or the volatile of the market, or the difficulty to compare between the different turbine products, or the depreciation patterns may get affected when we change the value of the turbine quite frequently. That's all.
Hello everyone, my name is Sagadal and I'm here for TACC605 Manager Accounting presentations. And my presentation topic is of Green Energy Limited with the question number 4, impairment indicators. Green Energy Limited is a company which runs wind power and solar powers with the recognition, management, measurement, depreciation, revaluation, impairment, and disclosure agreement. It also is a renewable energy organization for focusing on wind and solar power, and it has a key principle of the PPE, which rules for property, plants and equipment, and it also has an assist that must be held used for production or supply of goods and services expected to be used for more than 1 year. PB initial recognition is a cost includes with the purchase price, import duties, installments, site preparation, transportation, and testing. So the green energy turbine total capitalized is 5.0 million. The amount is recorded with the turbine initial carrying a balance in the statement of financial position. So the detailed cost at turbine cost 4.7, transport is 1.5, installment is 1.5, total recognized is 5. Depreciation is with the allows with the assist over its useful life of a span of 20 years. So the depreciation ensures the assist cost is matched with the revenue it generates over the time. For example, we have a calculations of like $5 million, like with the calculation of we can earn like $2.25 million every years with the which means with the annual income of in an annual statement carrying an amount decreases each year as the accumulated depreciation increases. So the revaluation model is like the turbine is measured at the fair price rather than the historical cost. If fair price increases, difference transfer to the revaluation surplus. And it also has some kind of impairment indicators like internal and external. For the external indicators are significant drop in electricity price, the new government policies and regulation, technological advancement that increases the external indicators price. And for the internal one, we have high operating or maintenance costs, lower than expected power generations output. For example, if there's no wind for a month, it's gonna create a less electricity to use, so it will be having a less revenue generation. And financial indicators are reduction in forecast cash inflows, indicators that amount ensuring may not be recovered with the same amount of or the given time. So here are one of the potential indicators of impairment and depreciation methods and useful values, power acquisition. I think that's all for now.
Our focus shifts now to the critical disclosure requirements mandated by AASB 116 for the wind turbine asset. The first key area of disclosure relates to the measurement basis. Green energy must explicitly state which measurement model is applied for the wind turbine after its initial acquisition, whether it is the cost model or the revaluation model. Alongside the measurement basis, the financial statement must provide comprehensive depreciation information. This includes detailing the depreciation method used, which green energy plans as the straight line method, and the asset's useful life or its applicable depreciation rate. Furthermore, the notes must disclose the gross amount of the wind turbine, combined with the total accumulated depreciation and accumulated impairment losses recognized to date. The second essential requirement is presenting a reconciliation of the carrying amount of the wind turbine. This summary is critical because it explains the exact movement of the asset's value over the reporting period. The reconciliation must itemize the movement, detailing the opening balance of the asset, any additions or disposals that occurred, the total amount of impairment losses recognized, the annual depreciation expense, and any other changes. This detailed breakdown ensures stakeholders understand exactly how the wind turbine's book value has changed throughout the year. Finally, because green energy is considering the revaluation model, selecting this option triggers substantial additional disclosure requirements. If the revaluation model is adopted, the company must disclose the effective date of the revaluation and confirm whether an independent valuer was used in the valuation process. Critically, the company must review the specific methods and assumptions used to determine the fair value of the turbine. Furthermore, to maintain comparability, the entity must disclose the carrying amount that would have been reported had the cost model been used. Lastly, the note must provide a clear breakdown of the revaluation surplus balance, showing its movements in the final balance. These specific details provide the necessary transparency for users to understand the impact of using fair value accounting on the balance sheet. Thank you, and we appreciate you taking time to review our analysis of the green energy case study.
And here's our reference list.